A very good afternoon, everybody, or morning if you're watching on the replay. It's Rob Stewart with you. It is Wednesday, the sun is shining, and look, I go away for 5 days, come back, and it feels like everything has blown up. I know it's been slightly longer since my last live stream, which was last Monday, so a week and a half. Been away for the last 5 days, and there's been a lot of news that's come out in that time period, a lot of media coverage of the housing market. So what I want to do today is I want to break that down. I want to look at two separate things. I'm going to start by looking at the lagging indicators that have come out in the last week, which is the Nationwide and the Halifax Housing Price Index. We'll look at those figures. I don't want to spend too much time on that because if I'm honest, what's way more relevant right now is the leading indicators for what's happening in the property market, specifically what's going on in the lending market. And that is seeing some fairly monumental changes right now, and it's generating a lot of headlines. And indeed, I feel is going to be shaping what happens over the next 6 months or so. So we're going to dive into that. We can have a chat about whether this is going to be sort of, apocalyptic, which I don't like to use. I don't want to go sensationalist, or is it just markets overreacting temporarily before we come back down? Remember what happened with that mini budget last year where the same sort of thing happened. Are we in that scenario, or is this a more embedded issue that we're going to have to be dealing with longer? Before I crack on with that, please give me a thumbs up if you can hear me and you can see me. There's no echo on. I'm not quite sure about the lighting today. I've got a new camera and it's difficult. It's much more technical to try and get the lighting right. So I'm not sure if I'm overexposed. Also been away, so it might look a bit red or brown, however you look at it. Okay, put something in the comments as well. Find that comments box. Make sure we're engaging. Get those questions in as we go through. I'll stop every now and again, look at the questions, and we can answer those. And if you're watching this on the replay, again, please put the questions in the comments box, and I'll always get back to you. That is my aim. Don't forget, this is my weekly rundown of what's going on in the property market. The reason I do this is so we can look at leading and lagging indicators, actually look objectively at the data, see what's going on to make us have better decisions as investors. This channel is specifically for people in the property investment, development, professional property space. Okay, with that said, let's dive straight into the HPIs that we've seen. We've seen two. Actually, why don't we start with the Nationwide, because the Nationwide did actually come out first last month. And when you look at the month on month, there's not a lot going on. We're 0.1% drop. Okay, it's kind of pretty much stable, right? I think what's more interesting to look at is that year on year. So the Nationwide reporting a year-on-year drop of 3.4%, which is the largest been. A lot of media coverage covered that. House rates dropping at fastest rate, or house prices dropping at fastest rate since the crisis, 2008 crisis. So we are definitely in negative territory with Nationwide. Let's just compare that with the Halifax, with the figures that came out with Halifax today. And again, a lot of media coverage on this with the annual. So if you look at the monthly change, we're zero, we're flat, okay? The annual change is minus 1%. So this is the first time Halifax are now reporting a year-on-year drop, okay? And I think the media have picked up on that quite a lot. All the headlines I look at today with property sections are, house prices dropping for the first time since the last crisis. I think it's 2012 or something like that, which is bizarre because that's what all the headlines were saying last week, but about the Nationwide house price index. So it's amazing how they just latch on to little individual sections of the news. And when we look at these, I think it's really important to contextualize this data we're looking at, okay? Last week's live stream, I went into a bit more detail about the difference between the house price indices, okay? The UK, which is the ONS one, Nationwide, Halifax, which are two lenders, and Rightmove, and how they work their different indices. I'm not going to go through that again. If you want to look at that, go and find last week's live stream where I go through crunching that data. But we're looking at the two lenders here, which are based on mortgage approvals. Okay, so not completions, not house price completions, mortgage approvals. So different to the ONS, which is house price sales. So what we're seeing is both of them showing year-on-year falls now. Okay, so they're in lockstep with that. We haven't seen a lot of change from April to May. Interestingly, spring is when we usually see a spring bounce. So this could be indicative that no real spring bounce in house prices, or we're coming out of the spring now, is best time to be selling. We're not really seeing that. We're seeing flat line. And of course, these are done on mortgage approvals, not completion. So this could all have changed in the last week or two with the inflation data, with the what's going on with lending, which we'll talk about in a bit. But I do want to dive into some of these points to talk about the narrative and try and read between the lines. Okay, so there we go. First annual decline in house price since December 2012 is what Halifax are saying. Interestingly, it's saying that detached properties continue to post modest house price growth. So detached are still more favourable than flats and terraces. And down south, and actually southeast and southwest, remain under the greatest pressure, which makes sense with this ongoing narrative that more expensive properties are suffering more, both with interest rates going up, so people who've leveraged themselves for bigger mortgages are struggling, looking to potentially downsize or have cheaper properties, and double whammy cost of living crisis, utilities and bills. People are now probably starting to think about next winter's utilities and bills. Again, we did some analysis on that last week, and even though wholesale price of gas has dropped considerably, we're still forward buying at a price that's sort of twice as much as it was pre-crisis. Okay, so we're still seeing evidence of that. Larger houses being put on the market, people downsizing or going to smaller, more affordable units. I do want to show or say, okay, I want to look at this, and I haven't got my pen with me actually, so I can't write on it, but just this paragraph that says, as expected, the brief upturn we saw in the housing market in the first quarter this year has faded. So if you remember, a lot of people were talking about the Halifax index. First quarter this year, we actually saw it month on month go up, I think 3 or 4 months in a row. And a lot of people were calling that as evidence that we're just seeing a tiny little blip in the market and it's continuing to go up. Right, even Halifax are now saying that brief upturn in the housing market has faded, with the impact of high interest rates gradually feeding through to household budgets, and in particular those with fixed rate mortgages deals coming to an end. Team, if you've been watching these for any length of time, you know that we've been talking about this for 3 months now. We've been talking about the data of how many people are on sub or 2% and lower fixed rate products. They're ending this year and next. 1.6 million this year. I can't remember what the figure is off the top of my head for next year, but we're still only halfway through the year, not even halfway through the year, right? We've probably still got best part of 700,000-800,000 people this year coming off 2% and lower interest rate mortgages, which is going to bite as interest rates come up. We'll talk about that in a little bit more. What is funny actually is they say, as expected, the brief upturn we saw in the housing market has faded. I don't recall them ever saying it was a brief upturn, they were forecasting a brief upturn. I think they were saying, I think the reports actually said from memory, UK market showing signs of health and growing. So it's funny how they change that narrative when they're seeing this data. We're also seeing in the indices mention of inflation, stubbornly high. Markets are pricing in 7 more rate rises that will take base rate above 5% for the first time since the start of 2008. So this is actually in the report now, talking about going above 5%. We'll talk about that in a sec. Those expectations have led fixed rate mortgages to start rising again across the market. I think yesterday Halifax announced, I think it was 0.75, 0.8% increase across their range, which is significant. This will inevitably impact confidence in the housing market as both buyers and sellers adjust their expectations. And latest industry figures for both mortgage approvals and completed transactions show demand is cooling. Therefore, further downward pressure on house prices is still expected. Okay. What does this mean? The actual reports from the lenders, right? Just get rid of all the fluff in there, right? They're saying house prices are going to continue down. This is the first time I have read a report that says they're expecting house prices to continue down. And these are the actual lending institutions who want to lend as much as possible. I read a report by Capital Economics. They've revised their peak to trough house price projection. I think it's from 8% to 12%. So they now say from here, they reckon house prices are going to go down a further 8% from now. If we go on the Nationwide, it's already about minus 4%. So they're talking about potentially minus 12%, which still, for me, feels light. I think what you can see is the narrative is now changing. Okay, the narrative is changing for the economists, from the banks. And no bank is going to come out and say house prices are going to crash, right? We'll never do that. But what you want to do is read between the lines and see what they're saying. So that narrative is saying house prices are coming down further, which is what we've been talking about every week. What's your thoughts on that? What's your thoughts on the narrative coming out from the markets? But more importantly, right, get that in the comments now. More importantly, I want to know about your thoughts about what's going on in the future for the next 6 months, 12 months, 18 months. Don't forget, these HPIs are lagging indicators, and the Nationwide and the Halifax are the smallest data sets. Okay, so they probably lag the least, other than Rightmove, which isn't, it's not the same model, but they are they're lagging and they're small data sets. So what does this tell us about what's going on over the next 6 months? Well, I think really this is the story we want to be focusing on. What's going on with this sticky inflation? What's going on with the lower than expected drop last week or the week before on the inflation figures, and the shock that's put through the lending market? Looks odds on that this month, okay, when you look at, again, mainstream opinion, odds on people are thinking the bank's going to take it to 5%. So we're at 4.5% at the moment. Odds on 5%, and I've even seen some commentators say potentially 0.75% raise up to 5.25% this month. Now, if we go back to the sort of predictions, even at the beginning of May, I would say 4 weeks ago, 3 weeks ago, pre-inflation, people were talking about 4.75% being the absolute top, and it might get there by the end of this year. Even I was saying, before those inflation figures came out, I'd expect maybe a pause this month to assess. I think that's unlikely to happen now. And we're talking about odds on going to 5%, so a 0.5% raise this month, okay? The banks are already pricing this in, okay? So over the last week, we've seen, let me get rid of that. We've seen a huge amount of products pulled off the market, some with very short notice, okay? And then they're coming back on with up to 0.8% more on the interest rates. This is a huge jump, okay? And I feel we're now coming into a critical point in this housing market. We're seeing interest rates continue to come up. We're seeing lenders starting to reprice significantly higher. And we're seeing more and more people coming off their fixed rate sub 2% products. This is probably the time, right, that's got most danger for people moving. What's inevitably going to happen? Some people have to move, right? Suck it up. I feel you're going to see probably a big clampdown, sort of freeze of people selling if they don't have to, and waiting to see, which is obviously going to affect the supply-demand curve. We talked about how actually I always thought that something that's going to make the housing market drop is a lot more supply coming on. Are people going to be moving now? But actually, they probably will, because when they come off those mortgages, they're going to have to move. And a lot of people have been on standard variable rates for the last 2 or 3 months, expecting interest rates to start coming down. So those people have come off their 2% or sub 2% mortgages. Standard variable rate, which at the moment for a lot of banks is 7%, okay, hoping that rates start to come down before they refinance. This is not going to happen. You've got a lot of people now probably missed the chance to refinance on those rates we've seen for the last couple of months, and they're now going to be refinancing 0.8% higher. Okay, they're going to be locking in that. Now, there's something that I think is really interesting here that I want to talk about in this article, and I know it's a garden article, but this stat here: record 19% of all loans taken out by first-time buyers in March were for 35 years or longer. This, for me, is something that I don't see anybody else really talking about, but is something that's going to cause a very long-term issue in our country, I personally believe. I actually did a bit of research onto this. Only a couple of years ago, you're getting 1 to 2% of loans are on 35 years or longer. We're now at, this says 19%. So we've gone up 10 times increase in the amount of people taking 35-year loans or more. And, it makes sense if affordability is being squeezed, people want to buy, they still want to buy their homes. The only way they can do it, or get the same home they want, maybe it's, maybe you're in a 2-bed, you want a 3-bed, or you're in a 3-bed, you want a 4-bed, you've had another kid, you need another bedroom, you need to upgrade, you want some more, more outdoor space. You want to get what you could afford a year ago, 2 years ago. The only way you can now do it, affordability-wise, is to take a longer loan term, right? Makes sense. Apart from when you think about, I'm just going to come off that because this is such a large issue. When you think about it, right now, I've not crunched numbers on this. I will crunch numbers on this probably for a pre-recorded video that goes on the main channel. When you look at 35-year mortgages, the amount of extra interest you'll be paying over the term of that mortgage will be significant, right? Significant. A lot of people will take 35-year mortgages with the mindset that they'll overpay and get it down to a 25-year mortgage, right? So they're getting the mortgage now so they can be affordable now. Then we'll get out of this affordability crisis. Hopefully we'll get interest rates drop at some point. Wages will go up and you'll start overpaying. But the reality is, psychologically, people rarely do that, right? Because there'll be something else that you want to spend your money on. Rather than investing it or paying down your debt, there'll be a car you want, or a holiday you want, or, go and shop at Waitrose rather than... I don't know what it is, but psychologically, very few people actually follow through on that mindset of overpaying their mortgage, right? So all of this extra interest, and it will be, on a typical mortgage, it will be tens if not hundreds of thousands of pounds worth of extra interest over the term, is taking away what you could be saving into other mechanisms or investing or putting into the economy, right? When you look at this on a macro scale, this is going to be something that will affect a generation in 20 years' time. I believe that, right? So I'm going to do some research and do another video on it. What do you think of that, by the way? What are your thoughts on... Well, because we've seen two things, haven't we? I mean, bizarrely, with all of this, last month we saw a lot of media attention on 100% mortgages again, okay? 100% mortgage. Obviously, we're going to be paying more interest on a 100% mortgage. It means you can buy your house, but right now, with house prices inevitably coming down, you're getting a 100% mortgage now, you will be in negative equity. Right? It's just obvious. You're effectively renting a house that's worth less, that you owe money on. Not quite sure I understand that one in this sort of market. And this is the same. So we've got 100% mortgages, right? We've got 35-year mortgages. These are all incentives to get people buying what they want to buy, which is probably overstretching, and this is going to hit massively down the line. So what's your thoughts on 35-year mortgages? I'll be interested to know, team. Okay, so look, we've seen a lot of products come off the market. We've seen a lot come back on with much higher interest rates. Narratives like this, okay, I'm seeing this almost every day in the media now. I do a daily sort of media alert sweep up of what's going on. More and more and more, I'm seeing articles like this where people are talking about the affordability and how they're being hit when they have to refinance. I'm remortgaging from 1.29% to a rate 3 times higher, okay? This gap is going to go up and up and up. And by the way, these mortgages that have come back on the market at a 0.8% increase. I think these banks, they're not stupid, right? They know that in a couple of weeks' time, whenever the MPC meeting is, those interest rates are going to go up, right? So people have not even started going on or refinancing onto these new mortgages. And I haven't actually looked at what mortgage rates you can get, but if I go back here, I think they'll probably talk about some rates. I think this is today's article. Let's see. No, it's got none of the actual rates in, okay, but I'd expect rates are certainly for 2 years. Again, it all depends on your loan to value. It depends on various things. We're going to be in excess of 5%, okay, probably. On a 75% loan to value, 80% loan to value property, we're going to be looking at 5% or more, especially on 2-year mortgages. And the other thing I'm starting to see, by the way, and this is something to watch out for if you're looking for finance, is to keep those rates low, we're seeing banks hide the rates by putting massive arrangement fees on their mortgage. If anybody else is seeing that, let me know, put something in. I saw one today. I did a quick browse through comparethemarket.com. I saw 2-year mortgages. So I put in 150 grand mortgage on a 200 grand property. 2-year mortgage, I think 2 grand was the lowest arrangement fee I saw, up to 4 grand. So a lot of them were sitting in that sort of 4.5 grand bracket. So the interest rates didn't look too horrific. They started with a 4, I don't know, 4.2, 4.3%, but a 4.5 grand arrangement fee, which when you work it out, 4.5 grand, right, over 2 years, I don't know if your maths are any better than me, it's certainly over 150. It's less than 200, isn't it? But it's over 150, 160, 170 pounds a month extra on your mortgage in arrangement fee. That is a significant percentage of your mortgage. When you look at the mortgage taking 150 grand, let's just call it 5 grand, to make it easy. What's that? 3.3%. So it's about 3% of the mortgage, right? You're paying an arrangement fee, which goes on. You're adding 3% onto the money you're borrowing, and you're potentially buying something now that might be going to negative equity, and you're layering that debt on. This cannot be a good state of affairs. Let me know what you think, guys. I can see we've got people on. So what's your thoughts about 1, these massive arrangement fees, 2, 35-year mortgages, 100% mortgages? What are you thinking about this gap that's ever widening with more and more people every month coming off their fixed rate mortgages, right? And interest rates going higher and higher and higher. What's this going to do to the market? How high are interest rates going to go? Let's look at some other leading indicators for the property market. This is mortgage approvals. I'm actually going to put this into line chart. I think it's easier to see, and let's go out for 10 years. Okay, this is mortgage approvals. This is taken from Bank of England data. It's not any particular lender. It's Bank of England data. Mortgage approvals, if we look, I mean, I've got it 10-year. If we zoom out to that 25-year, okay, zoom out to the 25-year chart, you can see on the right-hand side where we are right now. There are only 2 periods where the amount of mortgage approval has been less than they are now. One is COVID lockdown, right? We see that massive spike down. And the second is the 2008 financial crisis. Other than that, we are at the lowest number of mortgage approvals. If I just go into the 10-year, right, maybe I'll go 5-year. If you go 5-year, you can see this a little bit more clearly, that we had this big drop-off, kind of mini budget time last year, which went down to, what was that, end of the year. And then we saw an uptick and people going, look, it's fine. Again, mortgage approvals are going up, mortgage market's recovering. But you can now see we've kind of hit that and ticked down again, which is just classic patterns, right? Nothing goes up or down in a straight line. You've got to look at the trends. People that watch the channel, every single time I come live, I say, look at the trends, guys. Look at what's going on trend-wise. When you look at that graph, right, that trend is down in mortgage approvals. Mortgage approvals is another leading indicator of the health of the property market. Less transactions, it's going to be going down. We're way under, and we have been since Q4 last year. The sort of average trend from, you can see there, sort of 2018 to 2020 before COVID, which was sitting at 60, just above 63,000 a month. We got here, we hit 40 in January, 40,000, and we're probably, about 50,000 at the moment looking at that graph. So what's that, 20%, 30% down from the pre-COVID, pre-pandemic levels? And then the final thing I want to talk about today, if the internet will work. There we go. So this figure here, now this is from Nationwide Affordability Index, okay? This graph shows UK first-time buyer mortgage payments as a percentage of take-home pay. And I've kind of always used this as a metric for what the banks think is a painful mortgage rate. Because this graph, and this particular version of the graph now is a little bit out of date, right? It's 2022. So we've got the red dot there, which has mortgage rate of 5.5%. We're going to get there. I wouldn't have said that a month ago. I'm pretty sure we're going to get there now. At 5.5%, okay, we're pretty much at the same level as the peak of the last boom before the financial crisis. And not a lot below the peak of the sort of late 80s before we went into that long decline over the late 80s, beginning of the 90s. So I reckon we're going to get there, right? And this is going to be crunching that affordability more. It's going to affect people more. I'll be interested to see an update of this graph now. Don't forget, I'm not calling here for let's come off this. I'm not calling here for a catastrophic breakdown of the property market. I'm not calling for a 2008 style crisis, or of course I'm calling for it. I'm not predicting it. I still predict it's going to be a longer and shallower correction. We'll wait and see. But what I really think is going to be the issue is going to be the bigger correction is going to be the inflation base, the real house prices, and that's the one that's relevant. That's one we need to understand, because that's really what a house is worth, right? Nominal prices are nominal. Real house prices are what they're actually worth in buying power and currency. Now, the reason I think it's going to be longer and shallower rather than, catastrophic crash is because we have got, yes, they are slightly below inflation, but still we've got a strong labour market right now, strong wage growth right now. So that is propping some things up. It is slightly below inflation, okay, but it's still going up, negative in real terms, but not as much as the real inflation-adjusted property price are doing. So actually, wages are outpacing inflation-adjusted property drops at the moment. If we look at inflation-adjusted property drops right now, we are way over 10% already. We're probably, I don't know what the figures are. There's a quarterly graph that comes out. We're probably about 15% is my guess in peak to trough inflation-adjusted right now. I would certainly think that's going to be going to 20 to 30%, at least inflation-adjusted. Why does this matter? Because nobody really seems to talk about inflation-adjusted property prices. But it's so important for people because, as I said, it's actually the real value of our property. Let's use a stupid example, right? Let's say, you've got a property at worth $500,000, and in 20 years, it's worth $1 million, right? And you go, wow, I've made 500 grand. But if inflation has been rampant, You know, that million might just buy you a loaf of bread. So even though you doubled it, right, that million might not be able to actually buy you anything. I'm probably being, you know, a little bit dramatic saying all it can buy is a loaf of bread. But the buying power, the purchasing power for that equity increase is significantly under, you know, what things are now worth inflation, you know, with inflation. So really, you know, property's always been one of these is an asset that people talk about it being inflation proof. And of course, inflation is eroding our debt if we've got mortgages on it. But if it's eroding our debt, it's also eroding our equity right now. So it's a bit of a double whammy, right? With this high, and of course with, you know, cash flow issues, high interest rates, it makes it very difficult to actually service that debt in the first place. So it's more complex than just saying, one of my pet hates is gurus going, inflation's brilliant, right? Inflation erodes away the debt. Yes, sort of macro level, yes it does, but it also does lots of other things like raise interest rates and make unaffordability difficult. And by the way, I haven't even started to talk about interest rates going above 5%, going to 5.5%. When you start getting above that, we start to find ourselves in very, very tricky, a very, very tricky world, not just property market, but everything, right? At the moment, the one thing that's probably propping up the property market is that stronger labour market. How long will this last? Interest rates keep going up, right? Don't forget, businesses also have lending. We're talking about houses here. Businesses have loans. Those loans are either going up in value, going up in interest rate, going up in cost, right? Or businesses have fixed rate loans that they have to refinance. Maybe they've got their own mortgages. Businesses work on debt. A lot of businesses work on debt. That debt's getting more expensive. Well, this is why interest rates go up, to force us into a recession. Okay, get rid of this inflation because we're growing too quickly. It's too hot. They need to pop that bubble. What happens? Businesses, they can't service that debt. Well, debt becomes more expensive, right? They have to save money from somewhere. What else is really expensive right now? Wages going up. What's the first thing that businesses start doing? Making redundancies, laying people off. What if it gets to a point where the business can't even service the debt and then businesses start failing, right? This is when we start spiraling into a very nasty situation. All of which, you know, will happen at a certain interest rate. We're not there yet. And of course, the Bank of England, they're not going to just keep going to like 7-8%, because 7-8%, the whole system will melt down, right? So this will top out. That's my analysis today, team. Let me think. So Angie, I'm going to put this on Angie. So that's my analysis. Put some questions in, guys and girls. I'm just going to put Angie's question in. Private cash buyer looking for my next home. Not your demographic, but I find my Oh, okay, sorry. That's just thanks, Angie, for the nice comment. It's always nice to get. If you've got any questions about finding your home, I'm more than happy to offer it. I am helping people, other property investors. But this is actually, Angie, this actually comes on to a lovely segue as to why is this relevant to property investors, right? And I don't want to say where's the opportunity, because that comes across as opportunistic. And I feel there's going to be a lot of people in a lot of pain over the next 12, 18 months. That's not a good thing. Nobody wants that to happen to people. But all we can do is we can understand what's going on and make better decisions. This is why I present the information to you as I see it, but as objectively as possible, crunching through the fluff that's, you know, in the narratives, looking at the actual data, looking at the maths and seeing what's going to happen. I'm actually preparing a video at the moment on the commercial property space, which has seen a catastrophic crash. Nobody really understands the last end of 2022, last half of 2022. Commercial property went through the floor for reasons that I won't go into right now. But this does mean there are strategies, there are opportunities for people who understand the figures, understand the game, right, to invest into, because at some point, this will stop, interest rates will come down, inflation will come down, whether it happens in a year, 2 years, 3 years, 4 years, and the cycle, try and do it the right way around, will repeat. And I felt for about, and it's one of the reasons I came back into the property training space, it's one of the reasons I started this YouTube channel, was I think it's a fantastic opportunity for those who know what they're doing in this current market. It's a tricky market to understand, but for those who have the skills to accumulate now, right, then the next cycle, the next 20-year cycle, will probably create legacy wealth for those people. So things like commercial property, the price reductions in commercial property right now, significant, which means you can go in, you can buy commercial property at a much lower price per square foot than buying land, for example, or residential property, and be able to convert that using our planning system, which is potentially not fit for purpose, but there are some very generous permitted development incentives to turn it into high tech. I call these cash flow multipliers, right? to create cash flow multipliers which beat interest rates, beat inflation, and give you a very high yield on your cash, so return on capital employed. I don't want to go too much into the detail of this sort of stuff now. If you're interested about this, by the way, I do have a sort of a free introductory property course called the Property Cashflow Kickstarter, which I'll put a link in the comments to this and pin it afterwards. You can always just go and have a look, and it's got some sort of broad brush concepts of how to invest. One of my key metrics is ROCE, return on capital employed. Right, it's about maximising the returns we get on our capital or our investors' capital. This is so important now with the environment we're in, interest rates going up, people's cash flow and affordability being crushed. We need to be able to maximise returns. And there are some fantastic ways to be able to do that. And I'm not talking about going and trying and nabbing cheap properties off people who can't pay their mortgage. I've never been into that. I know the property industry is direct to vendor, all that sort of stuff. I like to find value in other places. Mixed-use buildings, retiring landlords, commercial institutional investors who are offloading commercial property. These are where the opportunities are. And these are where we can buy with significant discount. We can add value using a toolkit, and we can recycle funds to get a very high return on capital. That's why I set this channel up, to help people be able to do that and to understand the macros that are going on. Because when we understand that, it makes it easier to invest. Okay, there we go. That's my piece for the day. What are your thoughts? What are your thoughts on the market, team? Is it? Actually, do you know what? Before we stop, I've probably gone on longer. I only thought I was going to do 10 minutes, but for some reason I keep on keep on going and nattering. I understand that logging into the media, or reading a newspaper, however we do it, going to Facebook, and seeing all of these articles, stories, narratives about doom, gloom, property market crashes, interest rates, spiking up, people's affordability being crunched. I understand that it can make people anxious and nervous about life. And everybody goes through periods of hardship, tragedy, and it's important to make sure we have coping mechanisms for that, because media love to put out bad stories, right? That's how they get clicks. People very rarely click on really good uplifting stories, but they always click on catastrophic stories, which, I kind of make no apology for having sensationalist headlines on the YouTube videos that I put out, because I want to get your click so you can come here and we can talk about things in a rational way. If you're not here, we can't talk about them. But it is a psychological driver. Being consumed by all of that can put people into an anxious state. And I think it's important to have coping mechanisms, right, to get through these hardships. And it is difficult time. By the way, there are some people who'll be making huge amounts of money during times like this and markets like this. And here's the thing that helps me, right? Look at the big picture. Are we in control of what's going on? No. Can we individually affect interest rates? No. Can we affect the property market? No. These things are not in our control. So therefore, what's the point in worrying about them? I know this is easy to say. There's no point in sitting there worrying about these individual things, even though they're influencing us. All we can do is affect our immediate surroundings, right, and what we are in control of. And there are positive actions that everybody can take to mitigate what's ever happening and capitalize and take advantage of. And that's a choice. And I'm not saying it's easy, but I'm saying everybody has a choice about how we deal with this. And I do feel there is a lot of negativity. I mean, there always is anyway, right? There has been since COVID, and we've all gone into keyboard warriors after lockdown and all that sort of stuff. But not just negativity, I think worry, anxiety, and I can understand why people are anxious. I mean, for example, one of my mortgages, right now, before the interest rates, if they go up in June, it's gone from £1,300 to about £2,000 a month, £1,300 a month to £2,000 a month, £700 a month difference. That's just one of my mortgages on a commercial mixed-use building. But I invested smartly, and I've got a huge amount of excess cash flow on that property. So even though it's eroding my profit, it's not something that is going to put me under. It's not something that's going to go bankrupt. I've also got 7 figures worth of debt that's on fixed rate that's got another 2-3 years to run on it. So I have to start thinking about that if interest rates don't come down in 2-3 years. But the point is, we have choice. We have choice about how we can react, act. And if anybody is feeling anxious, my strong recommendation is to zoom out, try and understand what we can control and what we can't control. Don't worry about what we can't control and focus on what we can control, right? Focus on how we can re-engineer. Easy to say here on camera, more difficult to do in reality. If anybody, has any issues or just wants to reach out, please do. I'm always here. I'll be delighted to have a chat, if that is something that helps people. There we go. That is me done for the day now. Any more for any more? I'll give a couple of minutes. If anybody's got any specific questions on what we talked about today, on the market, any worries, concerns, any thoughts about how you are playing the market going forward. I'll give it a minute. Also wondering if that's slightly too bright on the settings. Cool. All right, team. It's been an absolute pleasure. Next live, maybe next week or the week after. We'll see what the next piece of information is. It's probably, if I'm honest, going to be Bank of England base rate. So I'll probably hold until the Bank of England base rate, because I'm sure there'll be plenty of chat over that. Otherwise, please don't forget to go and have a look at any of the other videos I've got. Lots of strategy videos that can help you. But I'll see you on the next one. It's been an absolute pleasure, team. Have a great end to the very sunny week.